we are going to do now, I'm reintroducing, we have done this before, I'm reintroducing the concept of double entry. Now, to do this double entry, you must know for now, for this stage, you need to know there are 6 types of account. What are the types of account you have?
Debit.
It can be an asset account, a liability account, a capital account, a drawings account, or an income account,
Expense.
or expense account. So all these are the first 6 accounts that you need to know. As you progress, we will introduce some other provision account and stuff like that. Okay? So now, what we know about this type of account is asset always increases on your debit side. Liability always increases on your
Credit side.
capital, credit. Drawings, debit. Income, credit. What is the justification why income increases on the credit side?
It increases the capital.
Yes, because your capital is going to increase. That's why income is on your credit side. And your expense will be debit because it's decreasing your capital. So knowing this now, if it's decreased, it's the opposite. Now, looking at this, let's look at this. We pay a creditor. Now remember, every transaction there must be debit and credit to balance it. Remember, accounting is all about balancing. So everything needs to have a debit and credit. Now look at this. We pay a creditor 70 in cash. What are the 2 accounts here? Creditor, cash. Creditor is an asset or liability? Liability. Cash is an
Asset.
So is creditor increasing or decreasing? Decreasing because we are paying, right? As a business, the creditor is decreasing and cash is increasing, right?
So
Oh, sorry. Cash is decreasing as well because we are paying.
Yeah.
So what happens when cash decreases? It must be on your credit side. So here we would write cash, debit, credit. Okay? Are you getting the idea? So if in the question they've given you, it has to be decrease in liability, decrease in asset. Now second one, bought fixtures by paying check. So 2 accounts here is the fixtures and check. Asset, right? Asset is increasing or decreasing? Here, this the check means it's a bank account. Now, asset or liability here? Asset is increasing or decreasing? So asset increasing will be debit, which is here, and then asset decreasing, credit. So far okay?
Yes.
Can understand your debits and credit?
Yes.
Now here, bought goods on credit. When we buy goods in accounting term, there's a special name for it. What we call that? Purchases. This is your purchases account. Now purchases goes into which category?
Expenses.
Alright? Purchases is an expense. So when we are increasing our purchase, so expense is increasing. Right? And credit, on credit, that means this is my liability, right? Liability is increasing as well. So credit. So debit purchases and credit creditor or supplier. Depends on whatever, because he didn't give us a name. Now, the next one. The proprietor means owner. Anything owner does goes into 2 accounts. What are they? Capital or drawings. Capital means it's increasing the amount he invested in the business. Drawing he takes up for personal use. Now the proprietor introduced another 500 cash into the firm. So this will be a capital account, right? Capital increasing. Capital increasing is a credit. Cash, asset is increasing, right? Asset is increasing, so debit. Okay? The next one. J. Walker lends the firm 200 in cash. So 2 accounts will be cash and J. Walker. So asset is increasing or decreasing? Asset is increasing. J. Walker is a liability, right? Because he borrows us money, correct? So liability increases or decreases? Decreases, right? So when asset increases, debit. Liability increases,
Credit.
credit. Okay? Next one. A name for debtor? Accounts receivable. Account receivable. So it's an asset, right? Asset basis by check. But check is bank. So bank is increasing, asset is decreasing. So asset decreases, credit, and then bank. The next one, we return goods. Now, when we buy goods, we call them as purchases. When we return goods, we call them purchases. When purchase is debit, purchase return will become credit. So this is our purchase return. So credit to the supplier. Supplier is a liability, right? Now we owe him more or less? Less. So liability is decreasing. Liability decreasing is debit. Alright? And purchase return is credit. Now last one. Bought additional shop premise by check. So this is your bank. Bank increasing or decreasing? Bank decreasing. Decreasing is debit or credit?
Credit.
Because it's an asset, right? So bank, and then shop premise is an asset. Asset is increasing. Debit. See? It becomes easier once you know this. Do not try to remember, oh, increase means debit, decrease means credit. Is it correct? No. It depends on the type of account. So, if I were to do in a T, this side is your debit, this side is your credit. Drawings, asset and expenses. These are the one that increases on your debit side. Liability, capital and income. These are the one that increases on the credit side. So I'm only talking about increase. If it's decrease, it must be opposite. Any problem? Okay?
Yes.
Alright. So this is also a revision before your